Hi, I'm Nino Gonzalez, and welcome to another episode of Making Sense. Well, today I'm going to talk about your paycheck stub. And the reason I'm going to talk about this is because I've noticed a lot of people don't understand the deductions that are coming out of their paycheck. And I'd like to take a show to discuss these deductions and what the taxes are being taken out of your paycheck and what they mean and what they go for. Now, also, this varies from state to state. So I will be using one where there is a state income tax, but in Texas, there actually is no state income tax. But we'll discuss that a little bit later in the show. So some of us, we don't even take a look at our paycheck stubs anymore, since sometimes they're sent to you electronically, or you have to go to a website to download your paycheck stub, and we don't even know the deductions that are coming out. And being a college instructor, I see a lot of students who don't know how to read a paycheck stub. So I decided, I think it's time to do a little show, a little tutorial on what to look for in your paycheck stub. So as we take a look, I have a picture of a sample paycheck stub on the screen, and most of them look this way, and here this person is being paid by the hour, $10 an hour and 32 hours, and they had some overtime, and that's being paid usually at time and a half. That's what the federal law says, time and a half, unless you get paid special overtime such as double or triple overtime, in which case that might be mandated by a union agreement, or it's a benefit that your employer is providing for you. But all the law says is time and a half once you go over 40 hours in a work week. Now, a work week is defined as 7 days. And usually the work week starts on Sunday and ends on Saturday. So a work week is not 5 days, but it is 7 days. So going back to the paycheck stub, here we had some holiday pay, and then they also are reimbursing this employee for some tuition. So we come up with a gross pay, that's not what you take home, of $4.52 and 43 cents. So then after that, we start deducting taxes. And some of these taxes are common throughout all the 50 states, and some of them are not, because it all depends in which state you reside. So the first tax I'm going to talk about is we have the federal income tax. Sometimes that is referred to on your paycheck stub as federal withholding. So sometimes you'll see it as federal withholding. Sometimes you'll see it as FIT, federal income tax. So they all mean the same thing. Sometimes we're not aware of these abbreviations, but they all mean the same thing, federal income tax. So how is that calculated? Well, that all depends whether you're single and whether you're married and how many allowances you're claiming. So I'm going to show you usually what you get when you're hired, which is a Form W-4. And the Form W-4, they give you a worksheet, but really, none of us take the time to fill out this worksheet. We really should, because the whole purpose of the tax system is for you to pay as you go, and when you file your tax return on April 15th is to owe very little money or get very little money back. We're under the impression that we want a big refund. But when you're getting a big refund, that means you're getting withheld too much. And you could actually be spreading that refund through your payroll checks and getting a bigger net pay. And if you know how to fill out this W-4, you take into consideration any special filing circumstances such as head of household, and if you are eligible for some of these credits. And you could really, if you know how to fill out this W-4, you can actually come out almost as close to zero as possible. The IRS on their website does have a calculator that takes you through all these steps. And you do have to put in some information and make some estimates, but by going through that process, you are actually honing in on how much tax you're going to owe, and when you file your tax return, the whole purpose is to come out owing very little or getting very little back. Because remember, when you get a big refund, you're being withheld too much, and you're lending that you're lending the government money without any interest. So I'm going to put the IRS website up here, and it is irs.gov, and you just want to type in the search. You just want to type in the search engine, withholding calculator, withholding calculator, and that'll take you through the steps of how much withholding you need to have. So that is how that FIT is based on. So it's based on this W-4, and usually what we fill out is this bottom part. And what we fill out is this bottom part, and you put either single, married, or married but withheld at a single rate. Now, what happens with the taxing system is that married individuals are withheld at lower rates than single individuals. So you got to make sure that you pick the correct box, and you only really have two choices, single or married. And what will take care of your head of household is by working out that worksheet and then filling in how many allowances you have. So single, married, what is this married but withheld at a single rate? That means you want your employer to withhold more in case you have maybe extra income that you're not paying any taxes on, and you want your employer to take the appropriate taxes out of there, so that way you don't wind up owing any money to the IRS when you file your tax return. So here it says total number of allowances you're claiming, and it refers to the worksheet, but usually in most cases, an allowance is your dependents, including yourself. So if you're single and don't have any kids, really you should be putting single and one, because you should be claiming yourself as an allowance. If you're single and you have 2 kids, well then you should be claiming single and 3, yourself and your 2 kids. If you're married and let's say you don't have any kids and only one spouse worked, then you would put married and 2 for yourself and your spouse. Now, let's say you're married and have 2 kids. Well, and your other spouse does not work, then you could put married and 4. If both of you work, then one should fill out married and 2, the other one married and 2, or married and 4 and married and 0. You don't want to put married and 4 and married and 4, and the reason because of that is because you will be double counting allowances. But usually an allowance is a dependent that you are claiming. Now, we can raise those allowances based on the different types of credits that you might be getting. And the only way you're going to figure that out is by doing the worksheet, and also or going to the IRS and working out that calculator, that online calculator at irs.gov. So that's the whole purpose of your federal income tax. Now, once you put there how many allowances you're claiming and whether you're single or married, then your tax, that is how your tax is calculated. Now, what do we use to do that? Well, usually nowadays computerized payroll programs will do that for you, but there is a publication that the IRS puts out, which we call Circular E, and this is what we refer to as the Payroll Bible. And it talks about everything you need to know about payroll. But towards the end of this booklet, and this is updated every year, is you have these allowances. So, and this is based on how often you're paid. Now, these are your pay periods, and the most common is going to be weekly, bi-weekly, semi-monthly, monthly. Those are the most common pay periods. A lot of people get confused with bi-weekly and semi-monthly. Bi-weekly is every other week. So, for example, you will get paid one Friday yes, one Friday no, one Friday yes, one Friday no. Where semi-monthly, it's every 15 days. So usually you'll get paid on the 15th of the month and on the last day of the month. So bi-weekly and semi-monthly are different. Now, if we take a look at these allowances, so if you get paid weekly and you claim single and one, you get an allowance of $76.90. So what does that mean? So that means on that $76.90, you're not going to pay any federal income taxes. So if you're single and 2, then it's $76.90 times too. And you will not be taxed on that. So depending on how often you're paid, that dictates your allowance. And each allowance on a yearly basis is worth $4,000. It's worth $4,000. So if you are married and 4, then it's 4,000 times 4, which is $16,000. That means you're not taxed on those $16,000. So if you really know how to fill out that W-4, you can minimize minimize the refund that you're getting, or minimize the amount that you owe, because the whole purpose is to come out as close to zero as possible. Now, as we look at these tables, and they look a little bit confusing, but I just want to go through this. And they're separated into pay periods. So you have weekly, you have bi-weekly, and you're either single or you're married. And they take you through the steps of doing this. You know, good thing we have computerized software that can do all of this. But as you can see, we have all these tables: bi-weekly, semi-monthly, monthly, single, or married. And here, basically what they're showing you is the tax brackets. So most individuals will fall between the 10 and 15% range, but our tax brackets can go as high as 39.6%. That's the highest tax bracket that we have. So when you hear an individual talking about, hey, this is going to kick me up to the next tax bracket, that's what they're talking about, because we could jump from 10 to 15%, from 15 to 25, 25 to 28, and so forth. So that's the long way of doing it. The short way is that they provide you these other tables, and they have them for single and married, weekly, bi-weekly, and all the pay periods, and it's based on how much you make. So let's say that we make $300 in a week. So $300 in a week, I would go here, 300, and then I claim single and 1, I would get withheld $19 of federal income taxes. So that is how your federal income tax is calculated. Everybody's tax situation is different based on your filing status, based on how many credits you're getting, based on the number of allowances. And sometimes I see a lot of people comparing their paycheck stubs and say, how come you got taken more federal income tax and I didn't get taken any, or vice versa? So everybody's taxing situation is different. So this is how your federal income tax is calculated. And you can also, there's also online calculators where they have this information and so forth. So that's one of the tax. Now, one of the one that relies on this is the state income tax. Usually we refer to this as SIT, state income tax. Now, as I mentioned earlier in the show, Texas does not have a state income tax, and there's only 9 states that do not have an income tax. And here are the states without an income tax. We have Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming, and they're states with nearly no income tax, which is Tennessee and New Hampshire. Now, why are these included? Because they don't tax wages. They do tax investment income. So if you have dividends or you get any type of interest, you are taxed on that, but not on wages. So out of all the 50 states and territories, there are only 9 states that do not collect a state income tax. That's why in the state of Texas, we have a higher sales tax rate, and we might have higher property taxes. But you could live in a state where you might have high state income tax and still have high property taxes. We're going to get taxed either way. So Texas is one of the states where we do not have a state income tax. Welcome back to the second half of Making Sense, and we're going to continue discussing about your paycheck. Now, I left off discussing about federal income tax. Now, especially for students, if their parents can claim them as dependents, then they would put single and 0 because somebody else can claim that allowance. So just a little note I wanted to point out. So if we go back to the paycheck stub, then we have Social Security and Medicare. Now, those are what we call FICA taxes. FICA. So FICA is made up of two taxes, Social Security and Medicare. And Social Security is 6.2%, and Medicare is 1.45%, and of course that gives you 7.65% in total. So that's your FICA taxes. So sometimes it's called FICA, sometimes they refer to it as Social Security, sometimes they refer to it as Medicare. Social Security is also referred to OASDI. What does that mean? That stands for Old Age Survivors Disability Insurance, because it's not just for when you retire, but survivors, for example, if you're to pass away and you leave children under the age of 18, they can collect your Social Security benefits up to the age of 18. And disability, if you become disabled at a certain percentage, you can start collecting Social Security benefits. So a lot of us are under the impression that Social Security is just for when you retire, but it's for other purposes as well. And Medicare, that is the health insurance that you will be getting once you retire. Now, a lot of people are under the impression that Medicare will cover everything. Not everything is covered under Medicare. Of course, prescription drugs aren't. You might have to get a plan that covers prescription drugs, and it only covers 80% of the covered procedures. You're still responsible for the 20%. So what I recommend to a lot of people that retire is buy a Medicare supplement insurance that will cover your 20%. So these are all different issues that we never think about, and we don't understand where this money is going to. So 6.2 and 1.45, that is our Social Security and our Medicare. So that's what those stand for. And sometimes you see it on your paycheck as FICA. And FICA stands for Federal Insurance Contributions Act. Federal Insurance Contributions Act. Now here, as we go through the other deductions, here you have a New York state income tax. Well, the state of New York does have an income tax. Texas does not. And if you live in New York, and this is not the only city, if you live in New York, you also have a city income tax. So the city of New York tax you. A lot of New York cities, they have a city income tax. A lot of cities in Pennsylvania, they have a city income tax, such as if you work in Pittsburgh or Philadelphia, they will impose a city income tax. And there's other localities that have a city income tax. So in Texas, we don't have any of those taxes. All we're worried is about the federal income tax. And here they're taking out state unemployment and state disability. So you're made responsible for that. Here in Texas, that doesn't exist. So it all depends in which state you live in and you're working. Now, for example, if I live here in El Paso and I work in New Mexico, which is our neighboring state, let's say I work at the casino at Sunland Park or I work at White Sands, but I live here in El Paso, I will have to be paying a state income tax because I work in the state of New Mexico, and the state of New Mexico does have a state income tax, even though I am a resident in the state of Texas. So for April 15th, I would have to file 2 tax returns, one to the IRS and one to the state of New Mexico. So as we go down to these other deductions, basically these taxes, you don't have to give us any authority to take it out. Other deductions, you have to give us the authority. Usually when you sign up for these programs, you sign that we can take these deductions out of your paycheck, or somebody else gives us the authority, such as court-ordered withholding, such as child support, such as if you fall behind on your student loans or tax liens or any of that stuff. Those are what we call garnishments, and the court will order us to withhold a certain amount from your paycheck. So here we have union dues, 401k, stock plan, life insurance, loan. So these could vary from employer to employer and employee to employee. So out of this $452.43, after we take out all the deductions, you're only taking home $273.85. So as you can see, all these deductions take a part of your paycheck, and we might not be aware of what is being taken out of our paycheck. That's what I recommend, that you take a look at your paycheck and you understand the deductions that are being taken out. And these are, what I'm showing you up here, these are quite a bit of deductions. Yours could be more, or they could be less. Now these, the 401k has a little star, and so does the tuition have a little star. And that means these are tax deferred, which means you don't pay federal income taxes on that. So a 401k plan is money that I'm putting away for retirement, and that doesn't go into the federal income tax calculation. It does go into FICA, but not into the federal income tax calculation, because I'm not going to be taxed on it now. I will be taxed on it later when I take out that money. And this tuition, some employees pay tuition reimbursement. So that is not a tax for federal income tax purposes. So if your employer pays for some of your education, they would include that in there, but you don't pay any federal income tax on that. And as you can see, that is an addition to gross pay, not a deduction. Then we have other benefits that you might be involved. Group term life, if here in this situation, this individual borrowed some money, so paying back a loan, and then you might have vacation and sick hours and how many you have left. So this is a good illustration of a sample paycheck. Like I said, yours could have more or less deductions. Now, here's some food for thought. On the average, so we have gross pay. We know we don't take home what? Gross. But we do take home net pay. So how much do we usually take? So including some deductions, and we're including some benefits in here and taxes, we usually take about 70 to 75% of the gross. 70 to 75% of the gross. So let's go with a 70%. So that means that if you're making $10,000, you only take home $7,000. That's at the 70% level. Now, some of you might be taking a little bit more, close to 80%, because you might not have any other deductions. All you have are the taxes. So what I would like for each of you to do is to actually calculate how much you're taking home. How would you do that? Take the gross, or take the net, your net pay, divided by the gross pay, and come up with a percentage and see how much of your paycheck you're taking home. Now, I have seen individuals that take home less than 50% of their paycheck, and what's eating that up is a lot of these garnishments, especially child support. So understand how your paycheck works and the deductions that are being deducted out of your paycheck. Now here, with this paycheck sample, you know, sometimes in your payroll remittance, they send you like a paycheck, but it says voided. Why? Because most of the time, a lot of employers are now doing direct deposit. So it gets directly deposited into your checking accounts. Or sometimes a lot of employers are doing prepaid debit cards, where they issue you a Visa or a MasterCard, and they put your money in there if you don't have a checking account, and then you can withdraw those funds as cash back or through an ATM machine. So sometimes we don't pay attention to our payroll check stub because in the past, at least, it was physically given to us. And out of sight, out of mind. Now, since we might have to go to a website, or they send us an email that your paycheck stub is ready, we ignore it. And a lot of things are happening like that, like with credit card statements and bank statements. Since they're being sent electronically, we don't even care to open them or take a look at them. But as part of financial literacy, we need to be aware of what is happening here. So going back to some of these deductions. So let's talk about Social Security. Now, not everybody pays into the Social Security system. Everybody pays into Medicare, but not into the Social Security system. For example, teachers at school districts, some state employees, some government employees, railroad employees, they do not pay into the Social Security system. For example, myself, being an employee of El Paso Community College and being an instructor, I do not pay into the Social Security system. So on my paycheck stub under Social Security, it should say 0. Because we have our own retirement plan. And so not everybody pays into the Social Security system. So you also have to be aware if you're in one of those areas where you might not be deducted Social Security. Does that mean I won't collect Social Security benefits? Not for the wages that I'm earning here at the college, but in the past, I did used to contribute to Social Security, so I will get some benefits from Social Security. So there's also a misconception that Social Security is going to go away. It's not going to exist when you retire. To me, that's a myth. That's a myth that we've been fed upon. As we take a look at politicians talking, especially during a presidential election period, none of them are talking about Social Security. Why? Because it's sacred. And who is the voting public? The voting public is usually people 45 and over. So they don't want to talk about Social Security. Does that mean it won't get revamped? Maybe. I think it might get revamped, but I think what you put in, you'll be grandfathered in if they change the system. But Social Security will never go away. I think it's here to stay. I think we would have a revolution if that were to happen. So another thing with Social Security, we were talking about a 401k plan. Well, 401k plan, you're putting money aside tax-free right now or tax-deferred right now, so that way you can have that money when you retire, because you can't plan on living on Social Security. The benefit is just going to be too low. And I've seen a lot of people that struggle just living on Social Security. So you need to make sure that you're contributing to a retirement plan, either through your employer or through an individual retirement plan, and make that money grow, because you need to supplement that Social Security. On the average, and this is some food for thought, on the average, and this is if you stay in good health, you need about $350,000 to $500,000. $500,000. You need about that much in order to retire comfortably. And that means maintain the lifestyle that you have. And that's if you stay in good health. If you have health issues, well, then that's going to go up. But this is just from your 401k or other retirement. This does not include Social Security. Social Security will just be some extra money that you would be receiving. So the time to start planning for retirement is not when you're in your 40s or your 50s. It should be when you're in your 20s, because either time is your friend or time is your enemy. So I hope you take all this into consideration as you take a look at your paycheck, and if your employer has a 401k, make sure you contribute it to it, and sometimes they match it up to a certain amount. That's money you're letting go if you don't contribute into it. Well, I hope this was valuable information, and we'll see you next time on another episode of Making Sense. Thank you.